actually put this up over on YouTube so I can see. All right, looks like we're live now. Very good. Okay, everybody. Welcome to Market Trends. I am David Russell, Global Head of Market Strategy here at TradeStation. It's great to be with everyone today. We're going to start off with some initial disclosures. What happened on that? 1 second. 1 second. Let me just start that over again. All right, 1 second. I actually see my problem. I apologize for that. Did something strange with my PowerPoint. Here we start right there. Okay, it's great to be with everyone. This is the first time we're using a new piece of software that will allow us to stream this to YouTube and Twitter or X. And at the same time, I have a webinar experience with some of you guys who came in through the TradeStation platform. All right. Go to the TradeStation website. I'm looking at this now. Everything looks to be going well. We're just showing these disclosures, and then we're going to share also some links in the comments in the chat if you want to learn more. Okay, great. Looks like we already shared some of those. So one of the ways we do these webinars is we have a blog on the TradeStation website. So if you're on tradestation.com and you go up here to the button at the top for the Insights link and you follow that, it will take you to the Market Insights blog. And right here we have a blog post that includes all the key information that we're going to be covering in this webinar today, some charts and things like that. So, for you guys who are new, what we basically do is we have a series of different workspaces and different points we kind of go through for that. And this is the some of the key ones we want to start with. I actually want to start today by looking at the S&P 500. Now, in this article, we have some interesting sort of patterns I wanted to kind of point out. And, from my perspective, we talked a couple weeks ago about the rapid and dramatic improvement in sentiment that occurred at the very end of October, the beginning of this month, when basically a lot of inflationary pressures really went away. And we've just gotten more and more of that today. But first, I wanted to start off by just looking at a few things right here on the chart that I think were important. The first thing is this is the hourly chart of the cash index. Now, as you can see, right around between 4,500 and kind of 4,515, there's various kinds of resistance. And if you look back on this chart, if you make it a daily chart, and you look back even a year or two, you can actually see going back sometime into the past that there were other points of resistance around here, going all the way back kind of around here, from late 2021. And then what's also interesting is there was an ugly reversal right here in April of 2022, late April of 2022, as the bear market really took off and people really started realizing the Fed was going to be hiking. And there was this reversal on April 22nd. And that high was a level we've been kind of watching on the rally up over the summer. And so now we see right around here, and it's right kind of between 4,500 and 4,515, this range that we're now pushing against. I'm going to put this back very quickly on the hourly. Now, this is one of the workspaces we share with you guys. In fact, let me just quickly remind everyone, if you go to our blog post today and you go to the downloads, there's a zip file in here. And the zip file looks like this. It has an MT public materials. It has a series of indicators. Most of these you guys already know. And then in these are a series of workspaces. So the way you would do it if you have the TradeStation workspace installed is that you would then install the indicators and then load the workspaces. Okay, good. So basically we're looking at some of those workspaces right now. And the one we're looking at right now is called MTES. And basically this has two different charts. It has an hourly chart of the cash index and an hourly chart of the S&P futures. So I like to use this one to actually see levels. So to the upside, like I said, 4,500 to 4,515, but then to the downside, there is a level that is important in my view, and that's around 44.44. And the reason I note that level, you can really see here with these hourly candles. You can look right here at 44.44. That basically that was a low back here in August, and then it was an area where we tried to bounce a few times, but it was also the daily close right before the September 20th Fed meeting. And that was, a day that had, September 20th, the Fed was hawkish, tried to rally broke lower and then continued lower. But the close the day before was right around there. So if you look here on our chart, we're kind of identifying this range. Now, I think it's important to realize what's really happening here, in my view, is that as the market accelerates to the upside, we're seeing extremely tight pullbacks, just tight periods of consolidation like we saw right back here when we were back against that high from October. You can see I put this shaded region on to show a tight consolidation. Now, let me just very quickly go back to the daily and show this here. But you can see that, this tight consolidation period really gave a sense that not a lot of pullbacks. And when you have this kind of violent snapback sort of rally, there are not a lot of people who are trapped long, who are entrenched longs, who are going to be taking profits quickly. If anything, it's people who miss the move and then start buying. And I compared this moment in history to November of 2020 after the election. We saw similar price action. We didn't pull back even under, the most we pulled back was a 10-day simple moving average. And then we just continued higher for several months after that moment in time in November of 2020. And I use that as a template for various reasons. One of them was the fact that sentiment also hit an extreme negativity. Now, as we highlighted last week, we saw the biggest improvement in sentiment last week on the AAII, American Association of Individual Investors, the biggest turn to bullish in over 10 years and the biggest drop of bearish in over 20 years. So this was in many ways I don't want to say life-changing, but this is a moment in time when things really do change. The expectations and understandings of the market changed dramatically in the first half of November with all this sort of flood of economic data that was pointing in a positive direction. I'm going to get back to this this hourly chart in a minute up here of the S&P, because I want to mention this is actually an article that was on Fortune yesterday. And they actually, I talked to them and they put my quote in here. It was kind of nice. Basically, I said, we got more Goldilocks today. That was after PPI missed. But I want to just kind of emphasize, if we look here in some of these key news events we highlighted, CPI was 0, PPI was negative. So it is interesting to see those two things coming together. And what is also interesting is Austin Goolsbee, Chicago Fed president, voting member of the FOMC, says we could have record peacetime drop in inflation. Today, I didn't have a chance to get this up, but Loretta Mester was on CNBC. Well, she gave a talk and then CNBC summarized it. She said that monetary policy is good where it is. Now, she has been one of the most hawkish people forever. And so it's interesting to see her more in that sort of position. Jeremy Siegel, who has always been very bullish, but he comes out and is taking victory laps. Mark Zandi of Moody's basically said, no more rate hikes. A guy named Nick Timiraos of the Wall Street Journal, who's kind of known as this kind of Fed whisperer, very much plugged into the Fed, basically saying they don't want to go anymore. So it is interesting to kind of see these pieces coming together. It's also interesting to see that today we had export and import prices way lower than expected. We had jobless claims higher than expected. So we're basically seeing the Goldilocks story just continuing to come together. And now I think what remains a huge part of that story, and we have not even fully yet felt the benefits of this, and that is crude oil. Now, we have been talking about the problems if you're bullish crude oil for about the last month. We have been talking, we did this article here on the Market Insights blog, and we've been talking about it. Oil fundamentals weakening. Now, we noticed this even at the time when everyone was freaking out over the situation in the Middle East. We had a little bit of upside after that, but we were highlighting essentially the coming inundation of crude oil inventories, and we got confirmation of that yesterday when the government reported another crude build. We're seeing concerns about weakness out of China. I saw today, it was on Reuters, I think it was Reuters. They said that there was Chinese data that showed that Chinese refineries use less oil than they normally do. There's apparently some number that comes out of China that says like what percentage of refinery capacity was used in the trailing month or week or something like that. But basically what they said was Chinese oil refineries were not running at as high of capacity as expected. That means there's less demand for gasoline in China or oil in general, energy products. So again, we are seeing right now exactly a bigger trend come into place. This is a trend that has been in place for the last decade, which is basically American oil production is flooding the world with oil. At the same time, demand is not going through the roof. And that sets up for a positive environment of falling inflation. And it makes it even easier for the Fed to not hike rates anymore. Now, speaking of the Fed not wanting to hike rates anymore, let's look here at the CME Fed Watch tool. It shows expectations of Fed policy in the future. If we look here at, I don't know, let's say May of next year, May or June, we basically have seen rate hikes not only disappear, but the current policy, the current stance pretty much disappear. If you just look, a week ago, it was a 50% chance that rates would be where they are in May. Now the majority or the probabilities favor a rate cut. And if you look to June, I think it was June, we see an even clearer one. We see right now, we're basically gone. All right, so a week ago, people thought there was a 32% chance that the Fed would stand pat through middle of June next year. Now we are seeing only a 13% chance of that being the case, and we're actually seeing a 40% chance of a 25 basis points cut and a 38% chance of a 50 basis point cut. So the market has changed rapidly. These things are following through, and I think it's important to recognize that happening so quickly, and it brings us back to this tight rally on the S&P 500. You'll notice that we didn't even get under the 8-day exponential moving average. And so I think right now it's important to realize that we have this resistance in play, but at the same time, things have changed now. Things have changed, from a macro perspective in terms of the Fed being very hawkish and the market believing that, to now things going in the opposite direction. And then we're also seeing things have changed technically. Let's go back to this blog post I have here, because look at this downward trend line. We were talking about this and we were saying the thing that really matters here is not the 50-day moving average or anything like that. It is this longer term trend line. This is a weekly falling trend line that started over the summer, and we are now above it. So in many ways, the summer pullback that was caused by that hot GDP report at the end of July and these other strong economic, each one of these highs occurred with strong economic data, and now it's swinging the other way. So I think it's important to recognize that we're kind of entering another period. And when you see oil continuing down 4 or 5% again today, it gives some confirmation that this is here to maybe stay. And when you consider the fact that the export and import inflation, the PPI, these things point in that direction. So I think it's kind of interesting. These very much match a lot of the things we've been kind of pointing to. We've been talking about the fact that the housing sector has, a very strong sort of dynamic. It has had a real snapback in the last week or two, and it kind of follows that pattern. So I'm going to just quickly finish what I wanted to say at the S&P 500. I mentioned potential support at 44.44. The highs are around 45.15 for now. And in many ways, for me, it's not even about levels necessarily or moving averages. It could just be rally, consolidate, continue. So we might simply be measuring not in terms of levels or indicators, but just time. Rally, consolidate for a week, continue. Or rally, consolidate, have one good beat down, one good drop of 1% like we had right here on the 9th, and then continue. And so it's interesting that this is what happens in my view when you actually see a sentiment turn. So let's look back here. In April and May, sentiment was also extremely bearish, and you can see is that we basically, once we started moving, it was just like rally, sideways move, and then just continuation. And then, so I thought it was pretty interesting that this sort of pattern of just straight up and then a sideways move, it's not even a bull flag. It's just a sideways move consolidation. It shows that there are really not a lot of sellers out there, and it shows that there's a greater number of people who want to be buying. Another thing I thought was kind of interesting. Let me just go through very quickly. All right, let me look. This is now our breadth workspace. So I've worked that before. What's interesting, looked at before with you guys, this is the MT breadth workspace. And, we've used this indicator when we look at the number of companies in the S&P 500 above their 20-day moving average and above their 50-day moving average. Now, this gave a premature buy signal back here. And it's not perfect, but it is an interesting sort of signal. But what's interesting is I've noticed that the real another way to view this is that when you see a period of time when both of these are rising, like for example, back here in March, you get continuation. Um, you know, these were kind of falling. There wasn't that same sort of clear upwardness. But if you look at this has now been trending higher. And if you look at this at other moments in time, like back here, October of last year, you can see they were both working higher. And it basically signaled more of an intermediate term improvement in the market. So I think right now we're in a period where this sort of improvement, more companies above the 20-day, more companies above the 50-day, this can now fall for a period of time. Like you actually see here, it actually kind of fell, but that doesn't matter. What kind of matters is this is the thrust that kind of confirms that there's been, an entrance, with of more money into the market with breadth. It's confirmed by things like the improvement in the AAII sentiment, which let's take a look at, because I actually haven't looked at it yet today. AAII sentiment survey. And what we can see here is, so this was the big thrust of improvement from 24% bullish to 42% bullish. Now it's 38. Nothing really changed. Nothing all that interesting on this today. But this is one thing I always look at. I mean, it gives you a signal once or twice a year. It gave an interesting sort of overly negative signal back at the end of October and back before they solved the debt ceiling. And then you saw a similar sort of thing. So in many ways, it was like we had these worries about the debt ceiling, and then that went away. Now we have the same thing of the narrative being inflation go away. And to be very clear, I'm not saying inflation is going away. What I am saying is that the market now is working with that belief. Again, most things in the market, one of the things we always emphasize on market trends is the idea that the market will act on beliefs. And then very often by the time they actually happen, the opportunity is gone. Buy the rumor, sell the news. That is one of the basic principles that we kind of try to follow. And I will also say on that note, just quickly look down here. We're actually entering now a period of not a lot of news. So at the very bottom, let me just emphasize that the upcoming event that I think is interesting is we have Fed minutes on Tuesday next week before Thanksgiving. From my perspective, that is now kind of something that we could actually see just a kind of drift into that, and the potential of anything for profit taking kind of after that, because that people are probably going to look for the Fed minutes to be dovish. I'm not sure at this moment in time, because honestly, the Fed, there have been times in the last 18 months when Fed minutes were very meaningful. The last several months, they have not been. And the other thing is that the Fed minutes, like for example, way back at the beginning of last year, when the Fed was going to reduce their balance sheet, they actually announced it in the Fed minutes. It was kind of interesting. But I think the thing we have to remember now is in many ways, the Fed is going away as a catalyst, not going away as an important thing, but they're not doing, 50, 75 basis points a meeting now. And people are less concerned about the Fed doing something important. So that could just lower the importance of things like the Fed minutes. I'm not entirely sure. I did want to just highlight that because at this point, we're in an interesting spot where things are kind of turning. And this working assumption we've had for the last 18, 24 months is starting to really, subside. All right, so let me go down my notes here. There are a lot of other interesting things. It's also important to remember next year is an election year. And that will have a lot of, historically, those are positive. And I think as we get toward that year, people are going to start to think about that and discuss, those sort of longer term trends and things. I do think it's important to realize if you look at the S&P over a longer period of time, I'm just actually going to do, this is my trading view chart, but let me just quickly show you, go to like weekly, I have a lot of things on these chart. I'm going to hide that. But basically, this is a long-term sort of, consolidation or basing pattern. If you look historically, the S&P has gone through these periods of about 20 months, like here with then continuation. There are other ones back here in 15 and 16, and you get about 20 months from the high consolidation. There was also one back in 2012, right around here, before it broke out above the highs from the last bull market in 07. So the key thing is we are right around that period of time to follow a similar pattern. There's a weekly chart we're looking at here, the S&P 500 on TradingView, but we are at that point now of 20 months in place where we're historically matching the previous weekly historical consolidation patterns that have been here. So I think it's just important to realize that. It's interesting to think that, to realize in some ways we have that downtrend here that I have shown in the other chart. But in many ways, as we work our way higher, these different levels, at a certain point, it's hard to really know exactly which ones exactly matter. It could be a period of a gradual sort of climb up to the highs, and then something that triggers the continuation higher. It's interesting, actually, if you look at right after Trump got elected, I remember this. It was right after, like in the new year, basically, right after, before he took office. I remember and then we kind of saw this quiet, sneaking breakout and then continuation. And this was actually the NASDAQ started rallying right at the beginning of the new year. I'm not saying it's going to be the NASDAQ again, but I think it's going to be important to be thinking in some of these longer term sort of time intervals, especially as we move to the new year and people are focusing on things like the election and politics and stuff like that. So I think right now you have to realize that the exact highs, it's not clear what levels we're kind of looking for. It could be just a kind of grind and then acceleration without some kind of explosive breakout, just a grind, acceleration, and before you know it, we're making new all-time highs. That's why I think that the key concept is tight consolidation in the coming weeks. Okay, so mentioned some of these things about the CPI being good, PPI being good. Retail sales beat expectations for the fourth straight month. So it's kind of interesting, and I think it's important to think about that because this was before gasoline. I mean, oil, I'm not sure where gasoline is now, but oil down 5% today. This is for October. So what happens when we get our November retail sales in December? What happens when people go holiday shopping and gasoline is 10 to 15% lower than it was 3 months before? I'm just saying it seems like we are laying the groundwork for it could be a pretty healthy holiday sort of season. It's interesting to see. So November Empire Index in the New York Fed. And one of the things I've been talking about, and we emphasized last week in the ISM Services report, we saw a dramatic shortening of how long it took for companies to follow up on business, which means they have slack. They don't have pricing power. It's deflationary. We basically saw the exact same thing today or yesterday in the Empire Index from the New York Fed. We basically saw that the delivery times are falling, orders are falling. Speaking of orders falling or of stock prices falling, look at Cisco Systems. I wanted to show you very quickly what came up on this Cisco press release. Okay, got it. Oops. Let me actually, you know what? I had a thing highlighted here. All right, here we go. Cisco saw a slowdown of new product orders. We believe the primary reason is that customers are currently focused on installing and implementing products. Oh, interesting. Following exceptionally strong delivery over the last 3 quarters. We estimate there are 1 or 2 quarters of shipped products still waiting to be implemented. In other words, people bought all the stuff they need to buy for now. This is exactly what we've seen. There are basically no shortages of anything, and people are working through inventories and basically the orders are not, high at this point in time. All of this is consistent with slack in the economy, falling prices, and a soft landing. We've seen it everywhere. We were talking recently about what was happening with Expeditors of Washington. Not a huge important stock, but they said very similar things about things like shipping and trucking. We saw it in the ISM services number, for October, and then we've seen it in these inflationary numbers. So all of these things. Also, CPI this week had lower shelter costs, and it had car prices down as well. So it's really interesting to kind of just see those sort of those those things taking place. I think all of them kind of confirm the kind of the inflationary thing breaking down. There's a lot of evidence at this point in time that it's happening. All right. Let me just go back down my list. The Cisco numbers came out last night, so it's not in my actual rundown, but it was interesting. It was interesting. A guy named Max Kettner, who's a strategist at HSBC, he basically said consensus estimates are too low for the S&P 500. So it's interesting to think about that because I actually have been tracking those numbers from Refinitiv or whatever it's called, the thing that the Thomson Reuters runs, and I've actually noticed that the earnings estimates of the S&P 500 have risen for 4 straight weeks. Interesting. Another report from S&P Global said the their risk appetite index is the highest in about 2 years. This is for big institutional investors. So just a couple of other things that were interesting was Intel got this upgrade on demand for PCs and data centers. And what's interesting is that Intel has been, in trouble, struggling for a long time. I think it's interesting to think about this. This is a Dow member, entering a new year. I mean, look at what GE did after it had this big sell-off. It had this big comeback the following year. It's interesting that basically it bottomed in October, and then it continued higher basically for the next 6 to 8 months into the new year. So if you think about Intel here, it's also been, under pressure for a long time. But it's interesting to see this kind of news coming out on Intel and then the reaction and the pricing. I just thought it's kind of interesting. And then the other one is Palo Alto Networks had bad numbers. And, I think this is an area now that is, somewhat crowded. The cybersecurity thing has really worked. But, Fortinet, which is the big name in the space, has had 2 bad quarters in a row. And now Palo Alto Networks. So I think right now we got to realize cybersecurity, these things trade at high valuations. They've performed well. And now we're seeing 2 big names with weak bookings and weak orders. So this is now a corner of the market that appears to be heavily owned and might be just a little bit tricky. And I want to just kind of emphasize that because when you see 2 companies both saying the same thing that are both important, I think it's just kind of important to keep that in mind. All right, that was our key news. Sector watch. So basically wanted to talk about just some of the areas where we see, kind of interesting strength. And so what we do now is we're going to go to our MT main. We're going to go to our key ETFs. Someone's asking me about Walmart. And, we can just look at this to see, who's doing the best in the last week, last 2 weeks. I like to kind of look over different time frames. And it's interesting to see that in the last, in the last 2 weeks, financials have really been performing well. And I think it's interesting that when you think of interest rates going down, and when you think of what's likely, interest rates going down, but the one that really grabbed my attention here are the home builders. Let me just mention, we have been kind of talking about the very strong fundamentals in this space. The numbers haven't been amazing. Today we got the sentiment number that was weak, but again, people see rates going down. Look at the 10-year yield here. And, this will pull mortgage rates lower. We've seen improving mortgage applications for the last 2 weeks, with rates where they are and what's been happening with rates and, the oil likely, pulling down rates more. Things like home builders are in a spot where, they could be an area where people are looking to come back to them. I think when you look at this over, if we go to a weekly chart, for example, here of home builders, you can see this was an all-time high. And basically, this was the summer of the market. This is when interest rates rose. But, you're looking at an area that, has some really interesting fundamentals. And so I think that's important to realize. But then also financials, if you look at the XLF has been holding a very important historic level from around 31.20 or 31. This goes back to 2007 and right before COVID. It was the all-time high before the financial crisis, and it was basically we tested it right before COVID, and then we crashed. And then what's interesting is we rallied back above it when the market recovered in 21, and here we are now coming down and holding it and making higher weekly lows above that 31 level, and with interest rates coming down. So for me, financials here are going to be an interesting sort of place. As we see a lot of the troubles caused by high interest rates start to fade. One of the troubles was the fact that people took their money out of the bank and put it into treasuries. So they had to pay more in their yield, their CDs and stuff. That was their funding costs. And then the other side, they made a bunch of loans, and those loans were tied to things that, lost value and rates moved higher, like commercial real estate. And that was a problem. But now all these things are those problems are in many ways kind of fading. So I think that's something we have to realize, to see this tight consolidation in the XLF as it remains above those old highs. So when people start to look to the new year, this could be an area that I think we have to kind of bear in mind. It's been abandoned, but they trade at relatively low valuations, and with a macro environment that could be more favorable in the next couple of quarters. So to me, financials are an area that we want to kind of keep on our list, and they're popping up here as one of the top performers in the last 2 weeks. I'm sorry. So this is what we do if you guys are new to market trends. We basically use Radar Screen here on the TradeStation platform that allows us to sort different sectors and ETFs over different time frames. What's interesting, if we look on a year-to-date basis, not surprisingly, semiconductors are at the top of the list. Software is number 2, but here housing is number 3. So I like to look at some over different time frames and kind of see what's doing well. And another thing that's really accelerating now, and I've been talking about this to a certain extent, is gold and silver. So let me just quickly show you this. This is gold on trading. It's just easier to pull it up here. But what's interesting is, basically to see it make this higher low. And then also the other thing that's important to me is the euro. The euro, we were talking about the euro bottoming as it held the low for the year back here. This was a low from like January, held that low, and it has been working higher since. If we continue to see strength in the euro, that is something that will probably be a positive for precious metals. Weaker economic growth, something of a positive for precious metals as well. So I think it's important to kind of recognize right here that all the headwinds, the things that should be headwinds for gold and silver, a hawkish Fed, higher interest rates, those things are now kind of maybe going the other way. And that is something that, we could see, some kind of expansion of that. So I wanted to kind of emphasize, that as a potential catalyst here for, for precious metals. We actually did an idea here on TradingView. If you're on our blog and you go here and you click on, see our TradingView ideas, and you go over here, we did this weekly chart on silver and copper. And we showed how, like, silver, there's a weekly sort of this wedge coming together, and it actually today crossed above the level we identified as a potential sort of entry point breakout line. We want to people will probably be looking for a weekly close above, I think it was 2390 on this chart, 70. A close above October's highs of 2370. This is a special quoted version of silver. It's not the same thing as silver futures, but essentially, this is an area where we have a descending wedge, and I think we want to just watch it because silver is something when it starts moving can be interesting, and a lot of people have been watching this particular sort of area as a potential for a squeeze, and I've been watching it myself, and so it's interesting to note that one. Now I wanted to turn to, let's see, I mentioned Austin Goolsbee, the regional banks, housing, chips and technology. And it's interesting, things like airlines and solar energy, these guys are actually highly sensitive to interest rates. And I think it's important to realize that, these guys had a lot of negative momentum on their charts. And, if you look at TAN, by the way, I will mention that these are, let me just quickly show you, these are the standardized returns for the different ETFs we're talking about. If you're interested, we actually have the disclosures for these as well. We share that in the chat. They're actually also available down here at the bottom of our blog post. right here for the prospectuses for these different ETFs. If you are curious about them, we do provide them in this blog post, and we have links to them on our website. And then these are standardized returns for them. Now, if you look at something like TAN, look at this now on a daily, we have a lot of bearish momentum here. And this is something that I think, is going to be interesting to kind of watch and see if it gets some stabilization. From my perspective, something like this, people might be looking to see this consolidate and hold these levels for several weeks and months before really getting interested in much of a rebound here. So there is this kind of attempt to say, hey, the airlines look great, but there's been a lot of technical damage here to things like American Airlines and stuff like that. So I wanted to just kind of mention that. If you look at a chart like this and you compare it to something like XLF, this one's above its 200-day, above its 50-day. In terms of where people are looking now for the interest rate play, in my perspective, that interest rate play now is more manifesting itself in housing and financials and less in things that have been really beaten hard, like solar energy or airlines. Okay. I just want to mention a few areas that I don't think get a lot of attention, but they've been interesting because there's a set of these companies that do contract manufacturing, and we list them here. There's like three of them: Flex, and then Jabal Circuit. These companies have outperformed on a year-to-date basis, and they're trying to bounce again. I want to just kind of point them out. They might be some interesting names that have some bigger kind of secular strength in them. Also, you have these bulk material companies that provide things like gravel and crushed stone, which also benefit from economic growth, and are economically sensitive. So they pulled back hard when interest rates, when the 10-year Treasury went over 5%. And I think it's important. That's Cemex, which is a cement company. And then another big one, I'm not sure I have it on this. It's MLM. It's on my list here, but these are just some names I think are interesting. They don't get a huge amount of attention. The other area that to me, people might be looking at over the longer term as we enter 2024 are going to be the private equity names, stocks like Blackstone. And what's interesting is these companies, you can see the 200-day moving average kind of basing out and moving higher on these. These are names that if we are at a peak in interest rates and the stock market continues higher next year, these are names that are potential beneficiaries of that situation. I did want to mention that energy has been an area that we have been, very cautious of, to say the least, and it remains in a problematic spot. We're going to have some ideas very quickly in a second here for some potential options trades. Let me fire up my Option Station Pro for that right now. Go to new application here on the TradeStation platform. Go to Option Station Pro. Going to fire that up. It has my cyan symbol linking, so any stock that I put up on the main chart will pop up on my Option Station Pro. It loaded up my other monitor. 1 second. I'll pull it over. I want to mention, I'll just show you this now. Occidental, this is one, I'm going to just pull this one up. For me, I look at a name like this. Look at it just kind of hanging in space. Now, what's interesting to me is if you look at, look at Coca-Cola. This is what I always look at, but they had this pattern where it just drifted sideways, and it was like at the 200-day, and then it starts breaking down, and then 50-day comes down, and it just goes boom. Look at Solar Edge before it sold off. It had this big rally. This is a rally in 2020, and it moved sideways, and then basically it got under that 200-day, and it just whooshed lower. So, there were a lot of other things that trigger this in Solar Edge. The fundamentals weakened, and, you could have said, well, why didn't it happen here? And all those things are true. But when the fundamentals broke, the stock broke technically. Look at Occidental. Crude oil, you could now argue that the fundamentals are breaking in crude, as we've emphasized, especially in this post here about oil. We emphasize this is the rising growth of American production, and this number has continued higher. There's this other thing today. Saudis increased their exports and increased their production. Interesting. I forgot to mention that before. This is on Reuters. So you can argue with potentially a weakening economy, increased production, growing inventories, that the fundamentals of crude oil and energy are now weakening, probably somewhat the way they were weakening for solar energy 3 to 6 months ago, when higher interest rates really put the squeeze on green energy projects. So now let's take a look at Occidental Petroleum here. And I just wonder, with a name like this that everyone kind of believes is like, oh, it's a Buffett name and it's safe. And I just wonder here, does this have the potential for some move to the downside? So let's take a look here in the Option Station Pro. And I was just noticing here, we go to do the December expiration. And we basically look at kind of a potential put spread of around kind of 57.5. So what we can just do is we can click on the actual ask, and then we can hold down control and click on the bid, and it creates a spread right in front of us. And basically right there, we can see a 2.5 wide spread is 45 cents. So basically that has a potential to make, 400%, because if it goes to its full width, you're talking about collecting $2.50 from a 45-cent debit. If the stock closes at 55 or lower, and that would be right about here. I don't know. To me, it's an interesting potential risk reward, because look at everything else in energy. ExxonMobil. Exxon's not as bad as I thought. Chevron, though. But when you consider, like this situation in crude oil, I don't know. It just seems like this could be something different potential. So I wanted to show that one as a potential thing. Another thing that was interesting is Dollar General to the downside. Dollar General, the discount retailers have really come unglued this year. And wanted to mention that because we did a Trading View ID on it back here. It was a little bit early, but at the same time, this might be an actual time when we start to see some selling kick in. We had this kind of false rally yesterday that failed. That might actually bring some more bearishness off the sideline. So this one today, I was thinking about something in Dollar General. Let's take a look also at the December expiration. And we can see here, you can see that it loaded DG because we have our symbol linking set both of these to cyan for global. You can see it's a rounded, and that means it's a global symbol link. If it's local, it means it only shares a symbol inside of a workspace. If it's global, it means it shares it across the whole platform. It's kind of cool. So this one was interesting to me to look at the 115. You could click on ask, and then the 105s, click on bid with it, hold down control and click on the other. And here we have a $10 wide spread going for about $3.10. Potential risk reward of, 3 to 1. And what's interesting about this one is it has to go to 105. Well, if you look on the chart here, 105 is right around there. I mean, that is not a huge distance away. And if sellers return to it, a move back down to 105 over the next month could be something that people kind of think is going to happen. Now, the other side is a name like Citi. This company's been cutting costs. They have a global exposure. And I want to just emphasize, I told you I had the euro, but don't forget, Citi has the biggest global exposure of the major American banks. So Citi here, names like this are very frustrating to buy options in my view, because, it can sit for 3-4 days and your options can bleed away time value. But these are the sort of opportunities when it can make sense. And I seldom am interested in selling puts, but this is sort of opportunity when selling credit spreads can make sense. Why? Because the stock pulls back a little, it has the momentum where people might want to own it. Or if it just keeps moving higher, there's still some, credit that you're going to collect on it. So I was looking at Citi and the 1st of December. Now, if we actually look here, what's interesting is look at what the theta. I don't have theta on here. I can go here to we're going to see that very often you're going to get the most time decay 2 to 3 weeks out. I'll show you later. Anyway, 2 to 3 weeks out for people selling options, that's when you get your fastest time decay into expiration. So if a person wanted to look in this case on the 1st of December, a person could, for example, this is purely for educational purposes, not a recommendation, but wanted to show. So the stock is at 44.5. A person could click on, in this case, the bid. They could hold down control and click on the 42 strike, the ask, and you're going to see it's a $2 wide spread with a credit coming in of about 40 cents. Now, that's something where, in theory, it could lose $2. But the thing is, if a person was to believe that this stock was trending higher, by doing that, what would happen is, say the stock falls to 44.80, 43.80. In this case, the person would be assigned shares at $44, but they brought in 40-cent credit, which means they really would be long the stock at 43.60. So, or 43.62 in this case. So the thing is that the idea of selling puts in something like this, or selling a put spread, what it does is it benefits from the bullish momentum on the short-term chart, but at the same time, it prevents the potential risk of a stock like this. It could just pull back $1 or $2, and if you're long calls, those calls just go vroom, worthless real quick. By selling puts, you could end up being assigned shares that you believe in a month or two are going to be higher. You could be assigned the shares, they could rally, then you could sell calls out from under them, and you could play both sides of it. So in my view right now, when you see things like the financials, and Citi was the one that seemed to have the most interesting sort of potential risk reward for something like this is when things like selling put spreads can make sense. And put spreads are usually not the sort of thing that really interests me, but in this case, there's a directional case to be made for them. And also, in my view, the risk reward of spending money on a debit is not very favorable with a name like this that could, easily smash down and just erase the value of any puts or of any calls you might own. All right. I also want to mention, I don't have any options ideas on these, but I did want to mention, let's just go to our price grid really quickly. I'm going to put in Advanced Micro Devices, Intel, and NVIDIA. Look in the last week. It's interesting to see that Intel and AMD are outperforming NVIDIA. I'm not going to say that these are better stocks than NVIDIA or anything like that, but NVIDIA is a well-known story. It's a well-owned, thoroughly owned stock. Intel is not. So I wanted to just mention, this could be interesting to see. Today, Intel is up 6%, NVIDIA is up 0.6%, AMD is up about 2%. It's interesting to see in the last week that we've seen real outperformance in those other names. So I think it's interesting because I'm just looking in the last, last few months and stuff. But I wanted to just kind of mention the fact that there could be a little bit of rotation, in particular to AMD and Intel, away from NVIDIA. NVIDIA, has just, it's a known story. It's not as new as some of the stuff happening with AMD with a decent quarter and some of these things that are happening with Intel, of this belief that they're coming back from the dead and stuff like that. So that was something I wanted to quickly share. We continue now with my rundown. All right, there's another name that, and I'm going to show you guys how I found it, GoDaddy. This one was interesting to me because if we jump over to our weekly chart here, and this reminds me of Garmin that we showed you, and this one is kind of continuing higher as well. But GoDaddy, basically, I'm going to do on a weekly really quick. And look at how this stock basically had this big move like last decade. I mean, like 6 years, and just nothing for 6 years. And now it's breaking out of this range. They had a good earnings report. And what's really interesting is that they are doing things with cost cuts. Now, I don't have time to get into it now, but we've identified historically, in previous webinars, I call them 7 catalysts of stock movement: volume growth, margin growth, strategic initiatives, business transformation, investor rotation, macro trends, and credit. Now, this is a question of margins. They basically, I'm not sure what exactly they're doing, but somehow they're cutting costs and their profitability is surging. So a company like GoDaddy, I mean, I think we all know it. It's almost like a utility, but the thing with a company like that is that they have ways to manage costs. Their revenue is probably relatively stable. If they bolt on new products, they can make more money. And if they cut costs, margins become a driver. And it seems to be what's happening here. There's some bullish analyst notes after last earnings report. This could be a new story. And when you see a breakout of something like a 5 or 6 year consolidation pattern near the beginning of a new year, you just have to wonder, is this now something that's more interesting? So one of the things we do when we do our mover of the week is, it's interesting. Let me just say here that it's up 22% year to date, and almost all of that gain, according to what I did, was in the last 2 weeks. Let's actually look here on my price grid on the TradeStation platform, my market trends main workspace, GDDY. Look at this performance in the last 2 weeks, 23%. Year to date, 24%. So what does that tell you? It tells you that the movement is in the short term. It's happening now. It didn't happen in February and it's moved sideways ever since. It's happening right now. People are reacting right now to recent news, and it's breaking out to a new all-time high, or, well, not quite yet, but it's pushing, and it's probably on track for a record weekly close. There's a weekly chart here on the TradeStation platform. So anyway, this is my mover of the week. So when I do the mover of the week, it's always going to be a company that's not in the S&P 500 or something like that. I kind of try to look at some companies that are, outside the index that maybe over time will join the index. Actually, before I do that, I'm going to finish up the webinar with that point. But the last thing I want to tell you guys was Lululemon. This is one that popped up today. I used some of the tools in the TradeStation platform to identify this stock. It made a new high and it pulled back to the 8-day exponential moving average. So I'm doing this idea for TradingView. I want to just point out, you can see MACD rising. You see these different gaps higher, adds to the S&P 500. So this is what I wanted to kind of point out. I want to just kind of mention that, to me, I've never even been in a Lululemon, but I have this sense, I'm a Gen X person, and I think that, for my generation, I remember, 15 years ago, 10 years ago, Victoria's Secret was this retailer that, a huge chunk of the population loved, and that stock was then Limited Brands, just had a tremendous run because of Victoria's Secret. I'm getting the sense, as I look at Lululemon, that it is the Victoria's Secret of millennials, or at least it is like a Victoria's Secret, meaning Victoria's Secret now is, forgotten. But there was a day when they could name their price for products. Their products never ended up on bargain shelves, and they could control, again, margins. They could control their growth. This one I think is very interesting. Lululemon, I want to just point out, this chart is very interesting. If you look at it, a lot of signs here of this. This is a period of a breakout, of a consolidation of about 5 to 6 months that today we're fighting our way out of. And we have this last pullback to the rising 8-day exponential moving average. Want to just kind of point that out. I'm going to be publishing this on TradingView soon. I wanted to just mention that. Now let me get back to what I was talking about with GoDaddy. If we go down here, like I said, this is a stock that's not in any index. So this is how we basically find it. I call it using the platform. This is the last section of the program I'm going to do today. I'm going to just very quickly show you how we did this. These are instructions for using Scanner. So what I'm going to do is I'm going to go new application, Scanner. Now, some of the things that we put in Scanner are I keep them in there almost as boilerplate. So I'm going to go to create a scan. I'm going to give it a name. I'm going to call it just today's date, so I know what it is. 23/11/16, and I just call it market trends. You can call it what you want. I have mine set, so I'm going to basically include right here all stocks, and then I'm going to exclude. I'm going to go to TradeStation symbol list. I'm going to go to index components, S&P indexes, S&P 500. I'm going to exclude the S&P 500. I'm going to exclude also NASDAQ indexes, NASDAQ 100. Boom. That means that it's not going to give me any stocks that are in the big indexes. So I hit next, and now what I'm going to do is, this already preloads to a market cap of 1,500,000 shares a day. You can tinker with that. If you look down at the bottom of my explanation, you can see I called those optional. The key things we want here, though, is those first thing with the symbol universe, we achieved what we wanted. We got rid of the big index names that people know. Now, the thing is that some of these names, maybe they'll be in the S&P in a year or two. So one of the things now we want to go to our scan criteria. We go to price, and we want to go to the price folder, and we go to percentage of 52-week high greater than 75. That means that it needs to be in the top 3/4 of its 52-week range. And then the next thing I'm going to do I'm not going to go through all of these. I'm going to go, well, I'll go to price and I'll go to, the other key one is I'm going on an indicator. And this is one you guys have. It's called days since 52-week high low. And there's a cool indicator that we've created for you guys, days since 52-week high low. And what this does is this counts how many days since the stock made a 52-week high or a low. You can actually make it to look for high or low. In this case, we haven't set the high. And we're going to say less than 10. And that's going to find stocks now that are basically that made a 52-week high in the last 10 days. I'm just going to hit, well, one last thing I want to do. I'm going to go to price. I don't have that much time, so I don't want to run out of time. Go to price. And I'm going to go to, let's go to percent change. And let's say percent change 10-day is going to be less than 100. So, you always get these stocks like some biotech that will go up like 150% in a day. And then it triggers a bunch of false signals. It's like some stock that jumps and, those are kind of crazy. So I want to avoid things like that. So what I'm going to do now very quickly, I'm going to actually set this to my same cyan global. So it now matches. And I'm going to look at these names that we get. And I can look, these are names now, and I haven't seen any of these yet. FTI, you can see, now this is an energy name. So I'm kind of wary here of, go set this back to daily. I'm wary of energy here, like I said, but there are some of these energy names that have done well that are now pulling back. But you can look down the list, and I'm just some of these are popping up. And this is just a way to find, these are names that are potentially in kind of bullish sort of patterns that are now having pullbacks. They made 52-week highs, and they're not in the big indexes. The last thing I would do just very quickly is I would now add index. I would go to indicator, and I would go to industry, and I would say does not equal quote, quote, meaning what this is going to do is this is going to force it to load the industry. And that will allow me to see what each of these companies are. Because you are going to find at a time like this, if energy is breaking down, there are going to be some energy stocks that were doing great that now look like bullish pullbacks, and they're just more like the beginning of potentially negative. So now we can kind of see the different sectors that they're in as we kind of look down our list. You can see here's a software company. Here is real estate operations. I don't even know what that is, but retailer here. And you can do other things. You can say, I only want to see stocks that trade 10,000 options a day to kind of hack out, to kind of eliminate some of those. The last thing, I had a question, someone asking, what do you think about Walmart? Thanks for joining me on our new webinar. I hope you guys think it's good, this new platform that we're using. But I would say with a name like Walmart here, the biggest problem for me with Walmart is that it's a safe name. And I think if we're in a period now of widening risk appetite, I think that safety is probably not something people are going to be interested in. What's interesting to me are to look at some of these other names here. I don't have them exactly, but there were several others. Target coming back, but there were some others. Williams-Sonoma had some interesting results. I feel like at this point, some of these kind of rebounding retailers that have really been in a tough spot might actually be some of the places to be looking. Things like Macy's. And I mean, it might sound kind of crazy, but the thing is, these companies have been through the ringer. They have rationalized their operations, and they seem to have margins now and pricing, and their inventories are under control. So a lot of them might be in spots where, the brick and mortar retailers have been in a secular downtrend really for almost a decade. They really started crumbling around 2014, 2015 when Amazon started really eating their lunch. I remember when it used to be drive around, and you saw like retailers closing everywhere back during, 2017 period. So, that period has passed, and these guys might finally be clawing back from the dead. The only thing is that each of them have unique stories and business models and risks. They take a lot of homework. They might be difficult. I don't know enough about them to recommend. No, I never recommend, but to even, comment on them intelligently. But it is interesting to see that names like Macy's and Kohl's and Target are snapping back. They might require some more kind of research or things. But the one that was interesting to me from a technical perspective that was popping out was Lulu. So anyway, guys, by the way, Lulu reports, they're expected to report in early December. They're not yet announced or confirmed. Hope everyone has a great weekend, a great Thanksgiving. We will be back the Thursday after Thanksgiving. And have a great day, guys. Don't forget to go to tradestation.com, go to the blog, and that's where you get all the information tied into our webinar today. Thank you very much, and have a great day.